Hi, everyone. Welcome to the webinar today. We are so thrilled to have you. My name is Alexandra Alvarado, and I'm the Director of Marketing and Education here at the American Apartment Owners Association. And today we're going to talk about a 1031 exchange strategy called the 721 exchange. It's the UPREIT exit strategy for 1031 exchange investors. And so if any of you have ever considered a 1031 exchange or are familiar with it, this is going to be a take on a slightly different strategy you can take. So we have with us our expert today, Matthew McFarland. He is the Senior Vice President with K Properties and Investments. And Matt is going to go over all of the details, but I'd like to tell you a little bit about him first. Matt works out of the K Properties headquarters in Los Angeles, but he helps clients nationwide with their 1031 exchanges and direct investments. And then prior to joining K Properties, he worked at a national commercial real estate tenant representation firm where he was involved in representing tenants in their leasing of commercial office, industrial, and flex space. So he has lots of knowledge in that space as well. And then now, since joining K Properties, he's participated in more than 2,000, that's a lot, transactions and over $15 billion worth of real estate. He works hand in hand with all the K Properties senior vice presidents, educating clients on what particular investments make sense for their situation. So he's the guy to talk to if you are looking to look for a specific investment based on what you're comfortable with in your, risk and all of those things. He is graduated from UCLA and holds a Bachelor of Science in Physiological Science from the UCLA Department of Integrative Biology and Physiology. So lots of expertise there, Matt. Thank you so much for coming on and talking to our group. Another thing that I wanted to share as well is that K Properties has their Investor Day coming up. You may have answered that question when you registered to say whether or not you'd like to go to it. It is a completely free event. It's going to be a full day conference in Torrance, California on April 23rd. So next month, mark your calendars if you can make it. Essentially, it's going to be a time to review different properties and investments and expand your knowledge, connect with all of the professionals in the investment real estate industry. So if you like what you hear today, this event is probably a great way to also connect in person. Matt, will you be going to the event in person? Matt, or will you be going to the event in person?
That's something or two.
Oh, I can't quite hear you, but could you say that one more time?
Yes, I will be there and very much looking forward to it.
Great, great. And essentially, some of the things you'll learn are some of the available 1031 exchange, DST, and 721 UPREIT offerings. You'll learn about the different opportunistic and income-oriented funds, triple net lease development offerings, real estate credit funds, lots there. If you are interested in attending and you said yes when you registered, we'll be reaching out with some more information about that. And hopefully we will all see you there. Um, and so, with that said, we are recording this and we'll send it out to you tomorrow along with the slides and Matt's contact information. So you can ask any further questions. We will have some Q&A at the end. So put your questions in the question box, not the chat. That way we can keep better track of them. So, with all that said, Matt, thank you so much. And I'll let you take it away from here. Oh, Matt, your sound is a little off. I think you did something earlier and it fixed it.
Try that. Is that any better?
Yes, so much better. That should work.
Okay, perfect. Well, apologies for the technical difficulties there. And thank you to everyone joining today. I really appreciate you taking the time. We really hope that this presentation is helpful and informative. I will say, just leading into this topic, there is a lot of nuance associated with the 721 exchange. So we're gonna try to do our best to break it down in a digestible format. And in order to do that, we're going to have a series of building blocks that come together. You'll see what I mean in just a moment here. But the 721 exchange is a strategy. It's an exit strategy that many DSTs have as a part of the business plan. And a DST is a type of 1031 exchange available vehicle, really geared for passive investors. So really excited to get involved and talk more about this in the next few minutes. And feel free, like Alexandra said, if you have any questions, pose those and we'll get to it at the very end. So before we jump in, as many of you are aware, with any real estate, there is risk involved. DST properties are no different. Each specific offering comes with a full private placement memorandum, which is the official offering document. And DSTs are only available to accredited investors and accredited entities. There's some more information here on what that means. I mentioned, these sections of the Internal Revenue Code are very complex, financial and tax concepts. So we always encourage investors to consult their tax and legal professionals. Um, there's a few different scenarios and topics that we're going to talk about today. These are hypothetical in nature. They don't represent any specific offering. Once again, just an educational tool to help kind of build that knowledge base. So just starting out, I'm going to talk just a little bit about K properties and investments first. I'll introduce the concept of the 721 exchange. We'll use the 1031 exchange kind of as a building block to that. Then we're going to talk about some of the advantages that investors are drawn to with respect to the 721 exchange. So just so you have a direction of where we're headed here. But first and foremost, K Properties, we are a real estate investment firm that specializes in DST or Delaware Statutory Trust investments, specifically for 1031 exchange investors. We have over 340 years worth of real estate experience, have had the privilege of working with over 2,200 investors purchase almost 10,000 DST investments nationwide, which totals more than 39 billion worth of DST real estate. For more information, our website, kpi1031.com, provides incredible access to not just the marketplace of different DSTs, but also a ton of great educational information. So we definitely encourage you, if you haven't already, please check out our website to gain access in both capacities there. So as mentioned, the main topic of this conversation is what's called the 721 exchange. So a lot of people are not familiar with the 721 exchange. The 721 exchange, much like the 1031 exchange, is a part of the Internal Revenue Code. It was brought out in the 1950s, and it states that no gain or loss will be recognized when a property is contributed to a partnership in exchange for interest in the partnership. Okay, so you may be thinking, I have no idea what that means. I like to, when I talk about the 721 exchange, kind of compare it to the 1031 exchange because that is a topic that many real estate investors are familiar with. So in a 1031 exchange, a 1031 exchange allows an investor to defer all of the capital gains, all the depreciation recapture taxes, really all the taxes that would ordinarily be due upon sale of an investment property. So what happens, the investor, they sell their rental property. The cash goes to a qualified intermediary, and that investor is able to reinvest all of those cash proceeds and buy other investment properties, right, for equal or greater value. So it's the 1031 exchange is a cash transaction, right? Cash is generated from the sale, and that cash is used to purchase replacement properties, and an investor is able to completely defer their tax. In a 721 exchange, there's actually no cash that is involved. So what happens is a real estate investor is able to directly contribute their ownership in property, in a piece of appreciated property, directly to a partnership, in exchange for interest in that partnership, and they're able to do it completely tax deferred. So just to kind of walk investors through the process. So the ability to do a 721 exchange, or be in a position to complete a 721 exchange, is made available through the DST structure in what we describe to be a two-step process. So the investor first must sell their property with the intention of executing a 1031 exchange, right? Which I talked about. So that investor, they decide to 1031 exchange, specifically into a DST in this example. And for those of you that aren't familiar with a DST is a larger kind of institutional caliber piece of real estate that is 1031 exchange eligible, where a high net worth accredited investor can 1031 exchange and buy a piece or fractional interest in that property that is going to be professionally managed for them for a set period of time with a set business plan. And so the DST is really the bridge to the 721 exchange option that investors, may consider. So once again, the investor must first, in this two-step process, they must list and sell their investment property. They must complete the 1031 exchange, into a DST that specifically has the business plan of taking part in this 721 exchange transaction. So once the investor owns interest in the DST, that property is owned and managed for a set period of time. And then eventually, a few years down the line, the property that the DST owns is contributed on a tax-deferred basis via the 721 exchange, into the 721 exchange, the 721 vehicles operating partnership. And so the DST investors in this example are trading their ownership interest in real estate in the DST for units, operating partnership units of this larger fund or REIT. There's a couple ways that the 721 exchange vehicles are structured. So this is really, really important to understand. It's really key to kind of understanding the process. Many investors will ask the question, can I 1031 exchange into a REIT? Or can I 1031 exchange into in an LLC fund? The answer is no, you cannot 1031 exchange into a REIT or a fund, but you can 1031 exchange into a DST that ultimately is 721 exchanged into a REIT or fund. So once again, the DST is the key component here. It's the bridge to provide investors the institutional access to this type of transaction, which is the 721 exchange. Hopefully, I know I'm being very repetitive, but I found that it's really, really important for new concepts to say it a couple different ways. So my hope is that that this is registering with everyone. So this is just another kind of representation of what I was just describing. You know, in that two-step transaction. So the structure allows holders of a DST interest to exchange their DST interest for economic interest in the 721 vehicle in the form of an operating partnership unit by contributing their property to the partnership in a 721 exchange transaction. So once again, think of the 721 exchange very similar to a 1031 in concept, right? It allows investors to completely defer all taxes. Only here it's through the contribution of real estate directly to a partnership. There's no cash involved in the transaction. So the next segment here, we're going to be talking about answering the why question. Why are investors drawn to the 721 exchange? Why is this an attractive option? We talked a little bit about the tax advantages. Many of you are familiar with the concept of capital gains, recapture, all of the taxes that would ordinarily be due upon sale of investment real estate. And the 721 exchange, much like the 1031 exchange, allows for investors to completely defer any and all taxes associated with the transaction. So that's vital to all of this, is the ability for an investor to continue to stay in a tax deferred state. Capital gains can be deferred until the investor sells their operating partnership units, which happens in a conversion from operating partnership units to REIT shares, or if the contributed property is sold by the acquiring operating partnership. So there's kind of two ways that taxes would eventually be triggered. One, if the investor sells out of their operating partnership units, or two, if that property that they're connected to within the operating partnership unit is the operating partnership is sold. So really, main concept here is continued tax deferral, right? That's a kind of a primary tax advantage. The second kind of driving factor here is diversification, right? Many investors who are first considering a DST are drawn to the access to diversification, right? They can sell a property that they've managed for a long time that has gone up tremendously in value. They may have a significant concentration of their net worth tied to that one property, or maybe a couple properties that they own and operate. And so the DST allows them to selectively diversify, right? They could sell the $1 million property that they've managed, for 40 years, and they can invest into 5 DSTs at $200,000 increments. And so, through the 1031 exchange into a DST, the investor is kind of moving away from concentration risk. And so the 721 exchange potentially allows for even additional diversification, right? From the one DST, which may own, one single property, or maybe it's a small basket of properties, into, in certain cases, a multi-billion-dollar REIT that owns and operates dozens and dozens of properties. So diversification is a really big part of this, and really getting away from any type of concentration risk, and even taking advantage of that to a more significant degree than is accessible, in a DST. So on the last bullet point here, you see kind of an example of an investor owning a $500,000 DST interest in one FedEx leased industrial building. That investor is able to do a 721 exchange, hypothetically, into a diversified portfolio containing over 2 million square feet worth of industrial, multifamily, retail, medical, mixed-use properties with many tenants, including FedEx, Amazon, Frito-Lay, Pepsi, Walgreens, CVS, Fresenius, just to name a few. So once again, it's continuing the diversification trend away from even just owning interest in a single property DST. So investors are drawn to that. The other component is income potential, right? So similar, to investors who are attracted to, DST, the idea of a passive, income stream realized through distributions from, sourced from the revenue that's being brought in from the different properties. That is something that 721 exchange investors are drawn to. And I think there's an argument for someone who completes a 721 exchange and is ultra diversified that their revenue source, which is ultimately supporting the distributions that they're receiving, is much more diversified, right? So kind of adding to what we were talking about before. So to continue that kind of passive, mailbox money type ownership strategy, it would, similar kind of expectation and desire with a 720 moving into a 721 exchange vehicle. Also the 721 exchange vehicle will have the goal of increasing income potential over time through, accretive acquisitions and kind of optimizing the portfolio as well. So just like, in a DST or, most investment properties, the goal is always to continue to grow, your cash flow and your revenue stream over time. And then, the last thing is with respect to the income potential, investors enjoy some tax advantages through, depreciation and other write-offs, just like they do in the DSTs and just like they did, owning their own real estate to help shelter, some of those distributions. Caveat to that, of course, each investor's basis dictates the significance of those write-offs. So it doesn't, it's not the same for everyone. The investor's basis would carry forward with them into the operating partnership. But certainly, continued, income, advantages through depreciation and other write-offs. In addition to, the potential increase in, distributions, investors are also able to participate in potential appreciation, which is realized at the individual asset level as well as the enterprise value level. So once again, the goal, within this larger kind of diversified fund or REIT would be to grow the property's value over time and see the value of an investor's ownership within the operating partnership grow as well over time. So investors would get the benefit of that and position to take advantage of market opportunities, right? This could be through new acquisitions or just enhancing current operations to grow the net operating income. There's more flexibility for select asset sales and subsequent 1031 exchanges into new opportunities with greater appreciation potential. And this is one of the kind of the differences within a 721 vehicle versus a DST. In a DST, when the property is sold, each investor is able to kind of freely dictate the direction that they want to go. So if a sale is realized, the investor would be entitled to their portion of the cash proceeds, and would decide if they want a 1031 exchange, in any direction or take the cash. In a 721 exchange, because you're dealing on such a larger scale, and looking at it more from like a portfolio perspective, making your decisions on like a portfolio level. The operator of that 721 vehicle can make, more calculated decisions that, may benefit the 721 exchange vehicle as a whole. Like for example, if there's a property that's, within the 721 vehicle that is, let's just say, underperforming or struggling, the operator may decide, hey, it might be a good time to sell and, exchange those proceeds into another holding where we can, take advantage of increased income potential and maybe, there's trends kind of moving, in another direction. So there's certainly more flexibility, from that perspective as well. To me, the main advantage that investors are drawn to with the 721 is the liquidity potential. So 721, a 721 vehicle may provide investors the option of liquidity on a partial or even full basis. And so this is attractive in two different capacities. The first is from an estate planning perspective. So investors really like the idea of, allowing their investors to step in and inherit their interest in a more liquid vehicle where their heirs can realize the stepped up basis and then, more immediately thereafter, liquidate out of the operating partnership at, you know, with the ability to kind of sidestep all of the capital gains taxes that investor realized over their lifetime, just like, if the investor inherited interest in a property or a DST, it's the same concept. The heirs are entitled to the stepped up basis. Only here, the heirs would have likely an enhanced ability to exit and liquidate in a shorter, period of time. So I would say, estate liquidity is a really, big driving factor of why someone would be attracted to this. The other is for just advanced tax planning on behalf of the individual. So because there's more access to liquidity, an investor can decide to kind of gradually liquidate out of their position, which would create tax liability, during their lifetime, but they can strategically do that, in a way to mitigate their net tax impact. So for example, if someone had, let's just say a $250,000 interest in one of these, 721 vehicles, let's say they wanted to liquidate $25,000, 1 year, they can realize, the gain on just the 25,000, right? And leave the rest of the 225 in the vehicle. So investors really like that. And some people, maybe they have, losses that were generated 1 year and they can use those losses to offset, any capital gains to minimize the overall tax impact. So, um, anyways, it just investors like the idea of kind of being in a more, liquid, vehicle relative to, like a traditional real estate holding or a traditional DST. I kind of jumped the gun on this one, but once again, just estate planning. So the operating partnership units can be equally split, or either held or liquidated by the beneficiaries of the trust. I mentioned there's the stepped up basis. to allow, the estate, the beneficiaries to avoid all the capital gains taxes and recapture taxes that were, generated over the course of the investor's lifetime. So that's a huge benefit, huge, kind of purpose behind, these various exchanges. And really just unlocking the ability for them to plan for the future with, the opportunity to transfer wealth to their heirs in the most, efficient way. Um, so this kind of last segment, before we kind of transition over to some Q&A, we're just going to go through a hypothetical case study to kind of hopefully drive some of these concepts home a little bit more. So here we have an investor that invests into a debt-free DST property that owns that single tenant net lease, FedEx distribution facility that we talked about earlier. So by completing, 721 exchange into the 721 vehicle, the investor, potentially can benefit from the following. We talked about, the full tax deferral via the 721 exchange, additional access to diversification, moving from the one property in the DST into, dozens of properties. In this example, 88 properties, over 2.1 million square feet of target portfolio across, different states. Here with 33 different states. So you're spread all across the country. We talked about, upside potential with respect to both, the income stream and also the principal value of the investment over time. The tax benefits, the depreciation deductions and other write-offs that investors have access to. And then the liquidity, over that investor's, lifetime, but also, the estate planning benefits with respect to the liquidity. So this is kind of the very high level, potential advantages, and benefits that investors, are looking towards when considering a DST. I will say, just as we kind of transition out here and move to Q&A, as I talked about in the beginning, 721 exchange is a complex tax concept, right? The 721 exchange, it's not for everyone, right? There's some investors where the 721, may not make sense for them. And I think a big part of our role at K Properties and what we're trying to get at is understand, each individual situation and ultimately what they're trying to accomplish, and be able to recommend specific strategies that may fit within, an investor's, short, medium, and long-term plan. The 721 exchange may be a part of that. It may not be. With respect to our platform, we have access to DSTs from, over 25 different sponsor companies. Each sponsor company is going to have a specific business plan for each DST holding. That business plan may or may not include a 721 exchange. So anyways, just wanted to kind of say that in closing. I think the one kind of main disadvantage that investors need to be aware of with the 721 is that there's no ability to 1031 exchange out. So once the 721 exchange is completed, the investor is stays connected to that REIT or that 721 fund for the rest of their tax deferred life, so to speak, right? Because there's no ability to 1031 out of that fund. So you have to feel really confident about, that particular fund or that particular strategy, and just be aware of, of kind of the business plan there, right? And this is all something that we review with all of our investors, kind of leading up to a 1031 exchange. And once again, as we're looking at different kind of exit options out of the DSTs. We really, drill down on this in a much more detailed way. There is a lot of nuance here, but from a high level, I think this is a really exciting strategy that a lot of investors, can benefit from, right? And it's something that we're um, seeing more and more within the DST space because the 721 potentially solves for, the or provides further access to liquidity, right? Which, especially from an estate planning perspective, can be very, very valuable, to an investor. So, just in closing here, I mentioned this at the beginning, but please, use our website as a resource. We have, free access to our marketplace of 721 exchange UPREIT opportunities, free listings of all the, DSTs that we currently have available. We have, debt-free and leveraged DST investments, access to, our marketplace from DSTs from over 25 sponsor companies. A ton of great free resources if you haven't already. We'd love to send you a book. We have, our property menu, our DST digest. We host free weekly webinars every Wednesday, free educational conference calls on the 1031 and 721. So anyways, yeah, encourage everyone. We really, appreciate your time. Hopefully this was helpful. We're here to assist, in any way possible.
All right, wonderful. Thank you so much, Matt, for all of that information. Really appreciate it. So we did get plenty of questions come in. I know you were very thorough. Appreciate it. Before I get into the questions, though, I know I had a poll question I wanted to ask first to you all. If you would like a complimentary consultation to help you defer capital gains taxes. So this would be with Matt or someone on Matt's team. They can really go over your specific situation. I know some of the questions that I saw in the Q&A were a little specific, so that's sort of where you want to talk to an advisor just to make sure you're making the right choice and you get to know exactly what's available and what opportunities you can be a part of. So I'm going to start with some questions. Please put them in the question box, not the chat. That will help me keep better track of them. The first question that came in was from Will Pedrosa. He says, income from DST. What type of income? Ordinary, passive, dividends?
Yeah, good question. So the DSTs, they all pay typically a monthly income, and it would be taxed as ordinary income. At the end of the year, investors file in Schedule E of their tax return. So just like, the current way for your current holdings. So yeah, monthly income, taxes, ordinary income.
Great. Ashlyn asking, can you do a 721 directly rather than having to 1031 into a DST first?
It's a really, really great question. Technically, you can. The reality for most of our investors is they don't own the caliber of real estate that most of these REITs or 721 funds are trying to buy, right?
Mm.
So a REIT is not going to be interested in buying, a duplex or a fourplex, right? A REIT's going to want to buy, $100 million, multifamily, right? They're buying at a larger scale. So because of that, like what I mentioned in the presentation is the DST really provides that bridge to access this type of transaction because when you buy into a DST, you're buying into a more institutional caliber type of real estate that would be the type of real estate that one of these 721 vehicles would have interest in acquiring.
Hmm. That makes sense. Will also asked fees from K properties.
So we're think of us as a broker or real estate agent. It's not the perfect analogy, but we're set up in a similar capacity. We earn a one-time transactional commission. Our commission's built into the cost of the DST, paid to us directly one time by the DST company. And just caveat, any and all fees for any offering are, fully disclosed in each private placement memorandum. That's all available on the website, and we'd go through all of that with all of our investors prior to investing.
Excellent. What about the time frame or term of the DST before exiting?
Yeah, another really good question. There is a range. On the short end, you're talking 2 to 3 years. Some of the 721 programs, they tend to target, slightly shorter hold periods. It could be 2 to 4 years. Traditional DST is going to be somewhere in the 5 to 10 year range for the most part. So it varies, based on the business plan, but anywhere from 2 to 10 years.
Great. And who benefits from the property appreciation at the exit? How is the value of the property or properties determined?
So the investors in the DST, and I'll talk about both, and in the operating partnership would benefit from the appreciation that's realized over the holding period. So in a DST, it's pretty straightforward. You own, an undivided interest in a piece of real estate. That real estate is eventually sold at a certain value, and each investor is entitled to their portion of the proceeds, right? That's generated from the sale. So any, appreciation net of, your closing cost would, each investor would benefit from that. There's no like profit sharing or anything like that on the sponsor level. In the operating partnership, what typically happens is there's either a monthly or a quarterly valuation that's done on the REIT or the fund level, where the sponsor company would reassess the value of the properties within the fund and set. It's called a net asset value is one of the valuation methods, and that's typically done through a series of appraisals. And so, the investors, share value or unit value, would adjust proportionately to the value of the underlying real estate that operating partnership, or that REIT or the fund would own. And the nice thing with kind of the more, I'd say, frequent valuation is it makes it easy for the estate to to point to a value for the step up, right? That they're kind of draw that line for the step up, and then more easily liquidate out of it. So yeah, in both cases, it's to the benefit of the investors.
And what is the time required to transition from a DST to a 721 exchange?
Good question. So the shortest time that you would see would be 2 years from the time that the last investor purchases, interest in that DST. There's kind of two different approaches to the 721 exchange within our space. There's the mandatory 721 exchange, which is defined as the primary business plan, um, you know, when that DST is created. So in other words, the investors that 1031 exchange into the DST, they know that the primary business plan is for the entire DST to be absorbed, into a larger REIT. And there's no optionality once the investors, buy interest in that DST. They're agreeing to be a part of the 721 exchange transaction. So usually the ones that are mandatory 721 exchanges, where that's the primary business plan, those are typically done in 2 to 3 years, so a little bit shorter hold period. There are other Other companies approach it as an option. Those, they can be in 2 to 3 years. They can be, 4 to 6 years. It can be even longer. But the optional 721 exchange allows the DST investors to elect if they want to cash out at the time when the REIT or the funds purchases the DST. And so, it just provides them the ability to, if they want to, take cash in 1031 exchange, they can go that direction, or they can 721 exchange into that particular fund or REIT. So, a little bit of nuance there, but yeah, I'd say 2 years would be the minimum. I think you're muted.
Oops. Another Matt on the call asked fees or penalties for liquidating the DST or 721 early.
Good question. So there's no direct fees or penalties liquidating out of a DST. Um, the reality with the DST, if you were to get out before or try to get out before the DST ran its natural course and realize it's a sale, there is a fairly thinly traded secondary market for DST interest. So usually there's some level of discount that would need to be applied in order to make that transaction happen. But in terms of like additional fees or penalties, on the sponsor level for liquidating early, that's not a part of it. It's just a matter of, the circumstance and situation, and honestly the value that someone else is willing to pay to buy in and take over, the investor's ownership interest, but before the business plan is realized. But usually there is some level of discount there in a DST, although we have had people sell at par value or even above par value in certain cases. So in the REIT or in the 721 vehicle, it depends on the type of structure that's being used, and the way that 721 fund or REIT is oriented. Most of them, they all will have like a 1 year lockup term from the time that the 721 happens and the investors move into the operating partnership unit. That's more for a tax reason to avoid what's considered a disguised sale in the view of the IRS. So regardless of the structure, there's always a 1 year lockup from the time that the 721 is completed. From there, most companies do not have any penalty, system or anything like that. It's just, depending on whatever their redemption limit is for a certain period of time. And, as long as they're kind of within those boundaries, they could provide liquidity at the net asset value, that of the fund at that time. There are some that are typically like privately structured funds or, maybe like a private REIT where I have seen some staggering penalties, so maybe like the second year there's a 5% penalty and then it kind of staggers down over the next couple of years. And so it depends, on the structure. But hopefully that answers your question.
Yes, I think Matt says thanks here. And I do think, the purpose isn't for it to be liquid the way, you could just easily sell a stock. It's a little different than that. Um, Safe asking here, is Kay also a qualified intermediary?
Good question. We are not. No, so that's a service that we do not offer and something that would be separate.
Yeah, and I know some, I'm sure you all do too, that we could refer to you once you get to that stage. Nicole asking, I own 12 multifamily buildings in New York City. I am currently in the process of selling air rights from one of those properties. Every property is currently under its own LLC. No DSTs or any other form of trust. I was looking to 1031 the air rights sale into another property that would also be its own LLC. Is there a smarter way to handle this? My initial thought was just avoid capital gains, but I have no prior knowledge of 721s or DSTs.
That is a good question. With respect to air rights, I am not an expert in that. So I'm going to plead the fifth here and defer to, seems like that's more of a tax related, question.
Mm,
If what I will say is, you know, within the scope of the 1031 exchange, um, if an investor is looking for something passive or looking for, access to, the 721 exchange, then that, the DSTs could be a good option to consider. But with respect to the actual, how you structure it, and how you deal specifically with the air rights, that's beyond my pay grade, so to speak.
yeah, it's very interesting, actually. I'll see if I can, we can find someone to connect you with regarding that, because I'm not too sure myself. So, okay, let's see if there's anything left in the chat that I didn't get to as well. I've covered the Q&A. So I think we already answered that one. Arcelia says, I appreciate the thoroughness. Carrie says, what size property does this work for? At what point does the fees support this process?
So I'll do my best to answer that with the limited context. But with respect to a DST investment, we work with investors. We've done $50,000 investments all the way up to 65 million, right? So
Mm,
there's a huge variety. It really just depends at the end of the day what the investor is ultimately trying to accomplish, right? And it's, if it's tax deferral via the 1031 exchange, how significant is your tax liability, right? That's the first question you need to ask to
mhm.
establish some type of relative basis and figuring out, like, should I just cash out and, not do a 1031 exchange and invest, elsewhere? Or if I do a 1031 exchange, it's really, do I want to continue to self-manage, or do I want to be completely hands-off and consider something, like a DST? So I always encourage everyone, really kind of drill down on the tax implication first, and then, depending on how significant that is, we also need to kind of look at, stage of life and kind of the advantages and disadvantages that DSTs, can bring about. Because certainly, I mean, when you invest into a managed, structure, whether it's a DST or REIT or anything else, that's being managed for you, there is going to be more costs, involved with that than you managing your own real estate. And for a lot of investors, at least for our investors, like those costs are totally worth it because they're able to, retire, take a hands-off position, diversify, get access to, kind of institutional caliber real estate. And it kind of marks this point in their life where they're moving from kind of a growth, um, strategy to a kind of a preservation and kind of retirement stage in their life. So if that's your situation and there's this, significant enough tax liability, then the DSTs may make sense, but they may not too. And that's what we're trying to find out.
Yeah, well said. Net is asking, do you get shares from the partnership when it's converted to a 721?
So you trade the technical class of ownership. So you own a beneficial interest in the DST. You trade that for operating partnership units. And those operating partnership units, if it's held in a REIT structure, those actually mirror REIT shares. So the 721, you don't own the shares directly, you own the operating partnership units. It's when you convert those operating partnership units for shares that you create a taxable event. And then so you convert the OP units to shares and then sell the shares for cash. and that's how you get liquidity out.
Okay, thanks for explaining that. Kai asking, can you swap to another 721 without a tax consequence?
You, technically, I believe you can, but it would have to be a situation where another REIT or fund happens to buy the existing REIT or fund that you're a part of. And not just that, but also allows the investor that option, right? So it's kind of this, yeah, technically there's a scenario where that may happen. The reality of that happening, maybe a little bit more slim. What the expectation is typically with these is the 721 vehicles are what are called perpetual life uh, investments or instruments, right? So when you 721 into the REIT or the fund, that fund is set up to exist into perpetuity, right? And the main reason is because they don't want to sell any of those properties and create a tax liability for the investors that own, the operating partnership units in a tax deferred state, right? So they're going to continue, or the plan is for them to continue to own and operate into perpetuity, and then put the impetus of liquidating on the actual investor and or their estate to control their tax destiny, so to speak, versus the tax destiny being, controlled for them through some type of liquidation.
Okay. Thanks again for the thorough response. I think we got all of the questions answered here on the call. So thank you for going through all of that. Before I let everyone go, please take the exit survey as you leave. I'd love to hear your thoughts on this webinar. And also, again, reminder that K Properties Investor Day is around the corner. So we will include some information about that in the follow-up email that we're going to send tomorrow. That will also include this full recording and the slides that Matt went over. So don't worry about that. If you want to get in contact with K Properties, we'll have that in the email as well. And I will also have an invite to our next webinar, which is going to be, let's see, about taxes, actually, a very tax time sensitive topic here. Specifically, some of your tax deductions, tax planning for this tax season. If you all are like me, a little last minute and procrastinate with your taxes, this is a perfect webinar for you to come to. The invite will be in the email that we're going to send out to you tomorrow. And so take a look there, scroll through the whole thing. And with all that said, Matt, thank you so much for coming on and talking to our group. We really appreciate it.
Thank you for having me. Really appreciate it.
All right, everyone, have a wonderful day. Bye.